Understanding the basics of a stock's balance sheet is one of the most important things you can do if you're going to invest in individual stocks. I know this video is on the long end for what, I normally do. And, probably about 20 minutes when all is said and done, but try to find some time, sit through this, watch it to the end. This is going to be the easiest and most informative video you'll probably ever see about stocks. And we're going to go over pretty much everything that you need to know about how to evaluate a stock's balance sheet. It's not nearly as difficult as you might think. And, you don't need any advanced knowledge. You just got to watch the video. And we're going to discuss the 7 metrics worth knowing and understanding. And then once I'm done telling you the metrics, I'm going to walk through a few stock balance sheets I've never looked at before and evaluate them in front of you live and just sort of go through the process that I would if I was evaluating the stock as if it was, completely new to me. And then I'm going to show you 2 more examples of stocks that I've already pre-screened just to show you some specific oddities that sometimes appear. Okay, so why understand a balance sheet? And if you've read my stock picking manifesto where basically I discuss my investing strategy, you know that I'm not a huge fan of numbers, but at the same time we need to understand these basics. And the reason for that is balance sheets allow us to see how the market values the stock. I like to invest in companies, not numbers, but I'm not the only person that does this. So it's like you have to understand basic financial sheets just to understand how much other people value that company, how much the street or the stock market values that company. And without understanding any numbers on the balance sheet, it doesn't really matter. And an example of this is like a company like Tesla. I really like Tesla. I think that Model S is a great car. But so does everybody else. So the stock is very expensive. And if you can't look at the balance sheet and make any sense of it to see, basically the market is projecting that this company is going to be a smashing success. So it's like if you need to be able to know that and know what you're getting into when you're going to take an investment like that, and understanding these financials is important for that. And another thing is that financial metrics allow us to compare companies. There are many great companies to invest in, but they're priced differently on any given day. So if you can, like with my portfolio, I usually invest in one additional position at a time or add to a current position. And when I'm doing that, I have to try to figure out which one is the best priced at the current moment. I obviously like all the stocks that I hold, but if I only have $1,000 of extra savings that I want to put into stock, then I've got to make a decision somewhere. So understanding financials basically gives you a better idea of which stock is cheap right now, so you can put your money in the cheap stock rather than, putting money into stocks that are great, but they've already run. You don't really feel like adding to that position right now. You might not be ready to sell the stock and take profits, but, having this financial knowledge will basically allow you to decide, what's expensive, what's cheap, and it'll help you push your money in the right place. Okay, so the first of our 7 key metrics is revenue. And revenue is just the amount of dollars that a business takes in. Good businesses seek to constantly increase revenue, and changes in revenue. Revenue is not earnings. Earnings is profit, and it's revenue minus cost. But revenue is still important to reference because sometimes cost cutting can fudge earnings. And what I mean by that is if the revenue stays the same, but the costs are less, earnings go up. So you need to be able to identify that, and I'll discuss an example of where this is important in a later slide once I talk about earnings. And revenue growth is just a measure of revenue changes over time. And this can be compared on a year-to-year or quarter-to-quarter basis. And when you're comparing quarter-to-quarter revenue growth, you should use the same quarter growth to rule out seasonal variations. And what I mean by that is if you're going to compare quarter 1 of 2012 to the next, or if you want to look at quarter 1 of 2013, rather than compare it to quarter 4 of 2012, which is the previous quarter, you need to go a full year back to quarter 1 of 2012. And the reason is there are seasonal variations. Most retailers and advertisers do much better business around the holidays because people are buying gifts. And likewise, if the company makes surfboards, they're going to have good quarters in the spring and the summer, and they're not going to do well in the fall or the winter. So, you need to use the same quarter. You need to use the same quarter of the previous year when comparing revenue growth. It's a simple calculation. You're just dividing new revenue by old revenue. So if this year, a company made 1.1 billion and last year they made 1 billion, 1.1 divided by 1 is 1.1, or 10%. So that would be 10% revenue growth. So faster revenue growth and future revenue growth cause stocks to be priced at a premium. So if you're comparing this to earnings, sometimes revenue growth can be forced. And what I mean by that is if revenue growth is massive and but the earnings growth is negative, that could mean that the company is spending an excess amount of money to try to force revenue growth. Sometimes that's good and sometimes that's bad. A company like Amazon is spending all of its earnings to build infrastructure to increase revenue growth so it can ship more products cheaper and more efficiently. That's good. A company like Groupon is hiring more sales staff to sell more businesses to inflate revenue. And that's never really going to translate into extra earnings unless they can cut the sales staff back, which they can't do if they want to sell those contracts. So this forced earning growth is not always relevant. So it's important to look at earnings too, just to make sure everything checks out. Or know what the revenue is being spent on. We'll add that qualifier. So earnings is just revenue minus expenses. It's the take-home profit of the company. It's generally the most important driver of a stock's price. After all, the end goal of any business is to make money. At least, a business you'd want to invest in. Some other businesses might want to do other things than make money, but you're not going to want to invest in those businesses. Maybe you'll buy products from them that you like. But really, earnings need to be the focus of any company that you're buying into. Or earnings growth, future earnings. And earnings can also be calculated as earnings per share, and that's just the total earnings divided by the number of shares. This value, rather than earnings, is what stocks typically are based upon, that is the stock price, and that just helps us account for changing number of shares. So if a company issues more shares or buybacks shares that it has out there, earnings per share will reflect these changes, whereas raw earnings do not reflect changes in stock count. So earnings growth, like revenue growth, is important. And it's just the growth in earnings over time, again, from same quarter to same quarter or year to year. And earnings growth in line with revenue, along with, we should say, revenue growth, is ideal and leads to increases in stock price over time. So if the company is growing revenue, it's growing business, and if it's growing earnings, it's making more money. So if it's growing business while making more money, that's what we want to see, because it means that the company is able to bring in new business, new profitable business. That's like the perfect scenario. So earnings growth and revenue growth are great. The more earnings and revenue growth there are together, the better. And the reason that this distinction is necessary is because earnings growth coupled with revenue loss is not always a positive. And what I mean by that is, let's say a company does $100 billion in revenue with $90 billion in expenses. That would leave their earnings at $10 billion. Let's say the very next year, they do $80 billion in revenue, but only have $65 billion in expenses. Earnings grew 50%, but the revenue fell 20%. And that means that while earnings grew 50%, if this trend of decreasing revenue continues, eventually the business will collapse, and you can't cut costs forever. If this was just a one-time deal, that would be good. Maybe they were cutting business that didn't make sense they were cutting out losing business and making the company more efficient. That's good, but if the next quarter or the next year comes around and revenue is still 80 or continues to decrease, that's terrible, because eventually they're going to run out of things to cut. A lot of times companies that are losing business announce layoffs, and if that is the case, they might grow earnings a little bit if they fire a bunch of people, but that's not a conducive practice to long-term growth. So in order to check for this, you just look at revenue. If earnings are growing and revenue's growing, good place to be. So all of these past metrics per se can all be sort of summarized in the P/E, which is the price to earnings ratio. And what this is the price per share divided by earnings per share. So, if you paid making $40 earnings per share and had a price of $1,000 a share, the PE would be 25, or 1,000 divided by 40. And this is the most popular method for quickly comparing the price of stocks because it's not dependent upon share count. Since price per share is at the top of the numerator and earnings per share is the denominator, shares cancel out. So shares aren't included in this count. So it lets you compare stocks where there's they have different numbers of shares, and you can compare how they're priced pretty easily. And there's typically an average PE associated with an industry. For example, all fast food restaurants might have a PE of X, whereas all cell phone creators like Apple or Samsung might have a PE of Y. It's just there's a typical trend for an industry, but then if the growth rate is higher than normal, the PE is typically higher than normal in a very predictable fashion. And usually, if the growth rate is twice normal, the PE is twice the normal. And as an example of this, let's say the industry standard for our particular industry is 15 for the price to earnings ratio, and that the average business in that industry grows 5% a year. And that's earnings growth. A company in that industry with 10% earnings growth would usually have a PE of 30, as long as investors believe that growth would be sustained. So if the PE was below 30, it means that investors think that 10% growth wouldn't last. And if it was above 30, they'd either think the 10% growth was going to last for a very long time or it was going to accelerate. So twice the normal growth usually yields twice the normal PE. And the only exception to PE is fast-growing revenue-driven stocks. So if a company makes no earnings, you can't really track its PE. And a stock like that is Amazon. And I'll discuss that in a live example later. If revenue is growing quickly, a stock might trade at a PE of 1,000, or even if the company doesn't make any revenue or earnings, it could still, have a price, even if the PE was, 0, or not 0, infinity. You can't really divide by 0. So one of the last metrics we're going to discuss is profit margin, and this is calculated by dividing net earnings over revenue. And this one metric, it's one of the least important metrics of our list, but something to know about. It's not typically reported on a balance sheet, but it is graphed on Google Finance, and I'll show you where to find that towards the end of this video. And most companies focus on maintaining profit margin while increasing revenue. And the reason this is it's hard to increase margins without cutting costs, and cutting costs is not always conducive to growth. So really most bigger companies, they want to keep the same profit margin. Let's say for every dollar they take in, they make 20 cents. Their goal is generally to keep that the status quo and get any additional business they can that lets them keep this profit margin. So if they made $1 billion and made $200 million on that, 20%, their goal will be to make $2 billion and make $400 million, or 20% of that. And again, this is not relevant to companies trading on revenue growth, because if there's no profits, there's no really margins to consider. And the final thing we want to discuss is debt. This is just a measure of how much companies owe to other entities. Companies take on debt all the time. It's not necessarily bad. A lot of companies do this strategically. For example, they'll borrow to invest in infrastructure that they need to do business. That's perfectly acceptable. And some companies will even borrow to pay a dividend, like Apple did. And they did this. The reason they did this is because in order to pay that dividend, they would have had to import cash from overseas to the United States, pay a huge tax on that, because they made the money overseas. If you want to bring money made overseas back into the United States, you pay money on that. You pay tax, like an import tax. And import tax is not the official name. Sorry to say that. I don't know what it's called, but let's say Apple sold a bunch of phones in Germany and their German branch made a bunch of money. They don't want to bring that money back to the United States because they'll pay a tax to the United States, even though they probably already paid a tax in Germany or wherever the corporation was overseas that sold those particular phones. So rather than pay a double tax, Apple just borrowed money and used that borrowed money to pay out its dividend and buy back shares while it still owns that cash overseas. And the only time this really becomes a problem is when companies owe more than they owned, which is measured in assets and cash. Because a company that owes more than it has is, they're worth negative, according to the debtors. They're not worth what they owe. They couldn't possibly settle their debts without making more money. And while borrowing to pay a dividend in the Apple case was fine because Apple had much more cash sitting around than it borrowed, if a company doesn't have that cash sitting around and is borrowing to pay a dividend, that's not a sustainable business model. Eventually that dividend is going to give way and the stock price is going to drop. So keep that in mind. Okay, so now I'm going to discuss a few live examples. The first two I have not seen. I just pulled them up. I pulled up Ford and General Electric, and I've never looked at their balance sheets. The first thing I'm going to say is that I'm going to remove this technical because you're not going to see that. And I'm just going to browse out. It looks like Ford's had a nice run in the last... no, that's a zoomed in a lot. That's a decent run, 17%, but not in line with the S&P. 6 months were down overall. We had a little dip here, then a jump up. Let's take a look at the financials. And we'll see that, Ford has been somewhat stagnant, we'll say. This is the quarterly. The only two quarters here we can compare are this quarter and this quarter, which that's a little bit of decent growth because remember, we only compare quarters in the same year. So let's look at the annual data. So here, I guess, represents the problem. They made... things were good here, and that's why the stock had a little bit of run. In 2012, they made less total revenue than in 2011. That means they sold less cars. Expenses were a little higher in 2011. So, wait. Somehow they got some sort of credit. Maybe they wrote off taxes, but the income before tax suddenly jumps up a lot to after tax. So possibly they got some sort of credit or something there, and that's fine. So let's look at some of the other metrics here. Let's find, click on balance sheet, and that's how we can see debt and assets. So currently they own a lot of assets. This is in millions, so they have like 200 million in assets, and total liabilities are equal to 174. So this is basically what they owe. Debt and all this other, what they're calling liabilities. I don't know if that's insurance contracts or for some reason they owe somebody money. So they do have more assets than debt, than liabilities or debt. So that's not bad. It's not great, but they've got more than they owe. So that's good. But yeah, to me, this revenue growth it's not what I'd like to see. The earnings growth is, technically negative, but it looks like that was the result of a tax credit. It's pretty stagnant. I just wouldn't want to own this company. I'm not interested in investing in stagnant companies. And sort of the return kind of shows that. 5 years, yeah, they were great, but everyone did good from the recession, especially when people thought automakers were going to go bankrupt. Look at the 10-year. This has been a poorly performing stock. I just wouldn't want a piece of it, even if you like Ford cars. This doesn't make any sense to me. They're not growing. I don't like that. Maybe to me, I need more than 1 quarter of a little bit of growth. I need quarter. I want I want to see several years of increased growth before I'm going to get on board with a company like Ford that's been around a long time. They're going to need to do more than that for me. So General Electric, this has been, rumored to be a well-run company. Again, if we're looking at quarters, we can never compare this Christmas quarter here to any other quarter because people buy stuff at Christmas. But we do see this quarter here, revenue was down, gross profit was down, expenses were about the same. We're going to see a decrease in earnings per share from this quarter to that quarter. I don't really like to see that. We look at the annual data, not too good over at GE. We're seeing decreasing revenue and kind of flat earnings. To me, that's, again, not a company I want to own. Earnings per share are actually up decently. I wonder what is this still displaying? No, it's displaying the year. I don't know why the graph looks like that when it's saying earnings per share up solidly. But I digress. We're going to look at the income here. Oh yeah, the income's up nicely. This is the real problem. Income's down from here to here, and there's some sort of financial trickery to help make the earnings per share go up. So it's okay. I'm not thoroughly impressed with their balance sheet. Like I said, to me, it's just the growth is slow. And again, 10-year, not performing very well. 5-year, again, everyone did well from the recession, but even then, they've only done okay. And year to date, they're about in line with the S&P, but not particularly good. 6 months, definitely nothing impressive there. I mean, 13% looks good, but lots of stocks did good over this time, so that's not really saying much. So to me, GE, flat revenue, I don't really like it. Even if you think it's a value, I just don't see what the upside is here until they're able to get business going again. So here's Apple. And I've looked at Apple's revenue sheet before, so I know what I'm looking at. And again, we can't compare these quarters here. We can't compare any quarter to a quarter that doesn't match up. So this one matches with this one. And the reason we see this huge spike here is a lot of people buy iPhones and iPads for Christmas gifts. And a lot of people buy them with their Christmas money. So it's not, these 2 quarters are always going to be higher. Instead, we're going to look at annual data. And the reason I really like Apple's chart to show you in this video is because it really helps to show us where profit margin is relevant. So we see Apple's revenue steadily climbing, on an annual basis, slowed down a little bit here, but still grew $15 billion, not bad. But you see this huge jump in operating expenses, and as a result, earnings per share actually dropped a decent amount. And that's what we see, this profit margin line here, it dips. And what that means to us is that Apple's not making as much money, which is why this stock is valuable. I mean, smartphones and iPads and tablets, they move so quickly that what's good today might not be good in 5 years. So we're really relying on this company to make a lot of money to give it its valuation. And let's look at their balance sheet, and we'll see that their total assets are big and their total liabilities are much smaller. And like I said, they took on a lot of debt to pay out their loans, but you can see they have such a large amount of assets between this long-term investments, which is basically just their cash that they're investing into a really low-interest fund. And as a result, I really like this balance sheet. I see that basically the biggest, let me take a step back. I do like Apple, and the thing that's the most concerning about this balance sheet is just this decrease in profit margin, slowing of revenue. But it's still pretty good. They've got plenty of cash, they don't have debt, and they're still growing revenue, and that's fine with me. And we see this quarter to this quarter, they're selling more products, so that's good. And I really think that this product line was even stronger than this year's, so I expect the next year to post solid revenue growth to continue. So another final one I wanted to show you is Amazon. So we see this PE is off the charts, and that's because Amazon spends all of its money. I don't know what I just clicked on. Let me go back. Okay, so we check out the financial sheet for Amazon. And what we'll see is that Amazon's able to grow revenue at a pretty rapid rate. This quarterly data doesn't matter because it's got all the quarters lumped up over here. Don't know why it does that, but we can see that on a year-over-year basis, Amazon's revenue is going up 20%, over 20%, about 25% a quarter. And it's just a straight line up. What investors are looking at thinking, wow, revenue growth actually accelerated here. If we were to draw a line, it's going to, it's slightly upwards. We're just looking at this projection out here. They're thinking in a couple years, Amazon's going to do $100 billion in revenue, which it very well might. And if you look at the earnings, though, there's not really much to say. In fact, earnings have actually been the worst ever in this 2012 year, and that's just because expenses keep going up right along with revenue. And part of that is that the cost of revenue is high, and this just means Amazon's products. They're selling products, but then they still have a decent gross profit here. They have $15 billion left over after paying for their merchandise, but then they're spending it on staff, and then there's a pretty hefty research and development costs. So they're putting this, what could be $4.5 billion of profit back into the business, which is perfectly fine by me. And whenever you have a revenue stock like this, you do want to check out their balance sheet a little bit. You can see that Amazon, when a stock isn't making money, they need to have at least a little bit of liabilities just to survive. And you can see that their total debt is almost nothing compared to their assets. So even their liabilities, their debt is very small, and even their other liabilities, just it includes all kinds of stuff. It's not even really debt. They still have more equity and assets than they have liabilities, let alone debt. They have very little debt. So as long as a company has little debt, they can get away with doing this. It's great even. You're putting your money into Amazon because you're hoping Amazon can do more with your money, so to speak. Not that they actually directly get those shares, or the price of the share. You're thinking that, well, my money in the bank account is going to do a lot less than money in Amazon because Amazon's intelligently spending my investment. So that's what you're banking on when you're doing this. And that's really it. You just want to be able to, oh yeah, I guess I should compare one. So let's say we did Ford earlier, and I didn't like Ford because, the revenues is kind of flat. Annual basis, they came out of the recession a little bit, but this is not good to me. And these quarters don't look particularly great either. So let's compare this to Toyota. Oh yeah, let's get back to here. You can see Ford has a pretty low PE ratio, just 11, and a market cap there. And I don't really know what Toyota is. I haven't really looked at them much either. We'll see that they're worth a bit more and that their profits to earnings ratio is a bit higher. So let's find out why. Okay, so the quarterly data, you can see from this quarter here to this quarter here, that's a sizable jump in revenue. They did this is in yen, so I don't really know, what the equivalent is, but you could say they made millions of millions. I'm not sure what that calculation is, but you can see that 5.4 to 6.2 is about like a 17% jump. That's big. And we can see where Ford, they've actually already put out this quarter. Or they already closed out their 2013 year. So in 2011 to 2012, they didn't do good either like Ford, but they grew nicely from here. This is just completely different from this revenue. And if we're going to look at earnings per share, we can see extremely profitable this year compared to last year. And that's the bottom line. The reason that their PE is higher than Ford's is because they're growing earnings faster than Ford. Not much, but faster. And, off of this big earnings, that's probably why they're trading so highly too. If they didn't have that, huge jump in earnings per share, this PE would be, or this market cap would be lower if it was in line with the same PE. And we can see that, unlike Ford, which jumped about 17% this year, Toyota's going to about 25%. And that's just in response to them posting a great 2013. They've actually trailed off a bit. Maybe their first quarter was somewhat weak, or they predict it might be weak. But anyway, that's really it for this video. I hope this was helpful for you. You can see all this some of these metrics. I'm not really too concerned with return on equity, return on assets. These are good, but, they're useful, but they're not, the main factors here. What we're really looking at is earnings per share, price to earnings ratio, revenue growth, earnings growth, and to an extent debt and profit margin. But those, those don't really come into play too much. So again, I hope this video was helpful. Subscribe for more stock videos, and definitely have some more great content coming out for you.